Hello guys, thanks for watching this. This is the third video of my series. Today we're gonna cover the banking sector. The format's gonna be the same. I'm gonna give some basic info on the industry in the first minutes, and then I'm gonna receive a specialist to answer some of my questions. Today I have with me Rahul Chatterjee. Hello Rahul.
How's it going, Tulio?
Hello, good man. Rahul has a background in fintech, early stage, and now he's moving for investment banking on the trading side in Citi Bank, London. So I'm gonna remove Rahul for a second, and then I'm bringing back in the end. So before we start, I'm just going to give a macro perspective on this, because we know that banks are highly impacted by how the interest rates are. And actually, in the last years, we are in historic lows in interest rates, both in US and Europe, especially in Europe, where the rates are very close to zero in last years and close to and negative in some of the countries. Moving, as we look, this will actually impact the revenue of all of those companies. When we look at the whole sector, we see that after the 2009, which was the best year, they were never able to recoup the same amount of revenue that they had before. Even that in last years, they have been growing their revenues is just 0.8%. So it's still very far to the average growth of economy. As the banks are pressured on the revenue side, we actually can see how they are behaving on this. And the way they are responding to this is with headcount cuts. So in 2019, we saw that just HSBC, Deutsche Bank, and UniCredit, they already cut 6,000 jobs. And this is a trend that we can see in some other important banks. As they were able to cut, to reduce a little bit their costs, they were able to manage better their profitability. So when we look at both US and Europe, they actually have been increasing their profitability, US by 4% and Europe by 11%. But when we compare this to the levels they had before 2008 crisis, we actually see that they never recouped the same levels that they had in the past. So this is an industry that definitely was already being highly impacted even before we talked about any type of crisis. One of the reasons was the, the growth of open banking, starting new business models, which are companies basically giving loans or other banking services, but they are not banks. Also, banks have been facing the lower interest rates, historically speaking, and this was already mentioned in previous slides. Also, neobanks enter the market, and as they are offering digital accounts in which the customer doesn't have to pay maintenance fees, this is pushing the profitability of the whole industry down. Also, banks have been trying to offer more customized products, especially investments for customers, and they've been using data in order to do that. Nowadays, customers, instead of have just one bank account, they actually have 3 or 4 in their cell phones. So this totally changed the way that the customer behave. And also regulation and compliance have been one of the top priorities for these banks. So following, it's still a little bit early to say, but we can already expect some of the new trends that are brought by this epidemic. One of them is that we are already seeing this, like there are new cuts in interest rates, and some of the central banks already performed this. Also, some of the companies and people that were dismissed, they're going to have some help from governments, but they also may end up needing the support of banks, and they're going to go after new loans. And also, as the crisis is going on, people, they're not able to go and visit branches and talk to their managers. Banks will need to find new ways of interacting with their customers. So with this in mind, I go to the questions, so bringing Rahul back. So Rahul, before we start, as the first questions, I would like to get from you a little bit more why the banking sector has been in last years with this slow growth and the profitability that it's a little bit more difficult to manage.
Yeah, so I think you covered it pretty well in one of your previous slides. I'd say there's a host of reasons as to why you could see that banks are slowing growth in the last couple of years, but to take 4 main ones, I'd say the first one is obviously a slowly reducing interest rate environment, where we've seen quantitative easing across North America as well as the European world, large amounts of money being pumped into the system and rates being depressed, and banks who depend on and interest rate margin to drive those bottom line figures, have really had to find new ways to figure out where the growth is going to come from. Secondly, I'd say that one of a really large impact on revenues that banks have seen is just generally competition in the whole passive investing space. ETFs and passive investing as a style have driven margins down quite a bit, and so banks are unable to compete on that front. And as such, traders, products, etc., their margins have been slimming considerably. Third, I would say that it's a regulatory thing as well. Post 2008, we saw large amounts of regulation being imposed on banks, and it's fundamentally changed the way that they pursue risk and the way that they have to set money aside when they want to do new projects. Mm-hmm. And of course, as you mentioned, the last point would be new challenger banks that have been stealing growth away from. In Europe, for example, many people use companies like Revolut or N26, and they're very happy just using that as opposed to an old, gargantuan established bank. So all of these things.
Yeah, you mentioned in your answer two of the trends. One would be the lower interest rates, another would be the entry of new banks. Which of these two do you believe are the most relevant?
I think of course the low interest rate environment is obviously at the forefront of many discussions when it comes to lending. Mm-hmm. We've seen over the last couple of years banks committing heavily to technology as well as diversification of their product lines. We've seen JP Morgan step into the retail banking space quite aggressively. We've seen Goldman Sachs, a company that used to rest on its laurels of only catering to the super rich, starting a new retail bank called Marcus, as well as a new credit card in partnership with Apple. So I think that is one thing they've realized is something that they need to figure out. How do we get new streams of revenue? Because their tried and traditional M&A and trading are not driving growth anymore. So I think the low interest rate environment is forcing them to really think of new ways to get revenue. I think that would be the number one big area. And with the COVID epidemic, with the Fed stepping in as well as the fiscal stimulus that we're seeing from Congress, it's only going to force these rates lower.
Okay, so that would be the challenge that you would highlight. So specifically talking about the epidemic then.
Yeah, that would be a trend that we would see.
Yeah, okay. And what do you believe in thinking on a traditional retail bank? What are the departments that are most impacted by this crisis? And looking at the retail bank and also an investment bank would be interesting.
Yeah. So even we can cover question 3 as well through this. So a retail bank basically gets its bread and butter is lending, right? So you have secured products such as mortgages, you have unsecured products such as personal loans. The main areas that we impacted is credit card receivables, unsecured loan portfolios, and secured loan portfolios. And so we've seen REITs, real estate investment trusts in the US, fall heavily in the market sell-off because they're very leveraged in their approach to doing business. And so really the concern here is, are people going to pay their mortgages, and how's that going to translate to these REITs and these mortgage companies being able to keep those amounts of leverage high going forward? Are they going to be able to make their payments going forward? That's the main question. Mm-hmm. Lastly, are people going to be able to make their credit card payments? It's still too early in the crisis to see. However, it's not too outlandish a scenario where if this carries on for a month or two, people are going to have serious issues paying their credit card bills. Switching over to investment banking, I think take it the way you want, but on a slightly brighter note, I guess trading revenues are being projected to be slightly higher. When there's volatility in the market, the way banks behave is that if volatility goes up, mm-hmm. all the trading positions in the banks have to be compressed. So they have to sell off positions and reduce their books.
Yeah.
And so they've been shielded a lot by the movement that you see in the markets, because they need to maintain a neutral book. And so they are actually doing pretty well. At least the first kind of numbers that we're seeing out of there seem to suggest that the banks are coming out. At least the investment banks are coming out of this, relatively better than the others of the industry.
And moving from the traditional sector to the new banks, do you believe that this for them is more a threat or an opportunity?
I think it completely depends. If you're a very new bank, you're going to have some operational issues for sure. You might not be able to meet certain payments. You might have to stop hiring people. You might have to let people go, because these new banks rely heavily on marketing, and unfortunately, marketing is the first department that gets marketing and advertising are the first parts to get cut immediately as soon as a crisis hits.
For sure.
So I think it really depends. Maybe the large players who have been there around for a bit, or the larger players who have been around for a bit in the neobank space, might be able to weather this slightly better. But the other guys, they've never really been through a crisis, so it's going to be interesting to see what happens.
Yeah, no, that makes sense. So it completely depends on how we were positioned before the crisis.
Yeah,
and
absolutely.
Now thinking on our colleagues, MBA students, if there's someone who is going to the sector right now, or it's intending to go into the sector, how do you believe this person could be better prepared based on this new situation?
So I think for people who are starting the MBA or are looking for internships right now, I think you're going to have to rely more on your own network than formal hiring channels. I think there's a slight distinction between those who are starting an MBA now and those who are looking for an internship actively right now. As far as people who are looking for internships right now, I think they're going to face a tough time, because I think internships are across the board. It's not surprising that they would freeze that. However, next year as well, I think it's going to be far more challenging, because I think people are going to tighten belts a little bit. As far as offers that are out already, there are no reports of banks rescinding offers on that front. But I do think that it is up. I mean, it happened in 2008 and 2009. I mean, it's going to be the same thing. Banks will never stop hiring. They need new people all the time. And so I would encourage people to start networking even more at this point. Like, keep your connections open, keep your conversations going, and it's just a matter of time before people resume, business as usual.
Yeah. Okay. Definitely, it's not an easy situation, but it's good to bring a kind of an optimistic view in the end. For sure, there is something we all can do, and the banks, as you said, they're gonna keep hiring. So we hope that everyone can go through this crisis, just one more, and then in the end, we're gonna be better as a society. Good. So Rahul, thanks a lot for answering my questions. Thank you for watching this video, and we'll see each other again in the next part of the series. Stay safe. Thank you. Bye.